you need to understand the principle, or let me say the concept behind trading before you put $1 inside trading. And in today's video, I'm going to give you a complete beginner steps on how you can be able to understand how trading works, and most importantly, how you can be able to get started as a forex trader. But before we go into that, if you're seeing me for the very first time, my name is Divine and I'm a forex trader. What I basically do on this channel is document how I trade and as well show you the mindset behind my strategy. If you want to see content like this, I want you to smash the subscribe button, like this video and drop a comment. I'll be right back. Now, in today's video, I'm going to be giving you a complete beginner steps. That means I'm going to give you a complete beginner course that will enable you to understand how trading works and how you can eventually develop yourself to become a better trader. And I'm going to be using 7 points to make you understand what trading is. The first point that I'll be using in this class is simply for me to use what forex trading is. What is forex trading? Now, this is going to be our first point here. That you need to understand what forex trading is, and most importantly, understand what it really is. Once you hear forex trading, it simply means the trading of currency pairs, foreign exchange. That means you're basically trading different countries' currency pair, right? What this means is, whenever you hear forex trading, you're simply using, let me say, USD to buy, let me say, gold, right? You're simply using currency to buy another currency, or you're simply using GBP to buy USD, or you're simply using USD to sell CAD. You're simply buying different countries' currency, right? And it's always in pair. That means if you choose to buy USD with gold, it's simply going to be in this pair, SAUUSD, right? And if you choose to buy GBP with USD, it's going to be paired like this, GBP USD. And if you choose to sell USD card, it's simply going to be USD CAD. That in pairs. You're pairing one currency to another currency. And if you look closely, you will see that each of these currency are coming from two different countries. For example, GBP USD, two different countries. USD card, two different countries. Currency pairs. That is what forex trading is. Now, these currency pairs are simply in base and in quotes. The first one that appears here is simply the base, right? And this one is simply the quotes. They're simply in base and in quotes, right? And if I'm to sum everything up for you to understand very well, once you hear forex trading, it simply means the buying and selling of a currency pair. That means before you can buy or sell currency, it has to be in pair. And forex trading is simply the buying and selling of two different countries' currency that is in pair, currency pair. I hope that is easy to understand. But I'm going to do my best to make sure that whatever I'm explaining in this video is going to be easy to understand. This is the first point, right? The buying and selling of currency pair. Now, for you to be able to buy or sell any currency pair, there has to be a broker, right? A broker. And a broker is simply a platform that gives you access for you to buy or sell any currency pair. What this means is you cannot just buy and sell currency pair without having a broker. You have to have a broker that will enable you to have access to be able to buy or sell any currency pair. Now, this broker is simply what provides for you currency pair and leverage. That means the duty of broker is to simply provide for you a currency pair that you're going to trade and give you leverage. I will explain to you what currency pair is, and I told you that if you want to buy gold, you use USD to buy gold, and it's simply what SAUSD. That is referred to as what a currency pair. Now let's look at what leverage is, right? A leverage, in other words, simply means help. And once you hear leverage in forex, it simply means that if I have money that I want to use to buy, maybe I have $100 that I want to use to buy 2 oranges, right? I have $100 that I want to buy 2 oranges, and my $100 can only afford me to buy these 2 oranges, right? But now I only have this amount of money, but I want to buy more oranges. The broker gives you a leverage that enables you to use this $100 to buy 20 oranges. So leverage is simply the help that the broker gives to you for you to be able to use what you have to get more of what you need, right? So in this case here, or in forex trading, let me give it to you in a forex term, that a leverage is simply the help that the broker gives to you, that if your $100 can enable you to open, let me say 0.01 lot size. By the way, I'm going to explain what lot size is as we continue, but let me just try and make you understand what leverage is first. That if you have $100 and you can only use this amount of lot size to open a trade as a trader, that the broker can give you a leverage that you can be able to use this $100 to open maybe one lot size or even more. This is referred to as leverage. As we continue, I'm going to make you understand what leverage is. Sorry, what lot size is as we continue. Now, the next thing you want to understand now is to simply understand the concept of trading. What is the concept behind trading? Why are we trading? That is the next thing we want to understand. Now, the concept, or let me say, the idea behind trading is to make money. And for you to be able to make money, you simply need to understand a particular concept of buying at a low and selling at a high. That means the whole idea or the whole concept of trading is to be able to identify the point you can buy from a low and the point you can sell from a high. This is just the simplest concept of trading, that anybody you see in the market trying to buy or sell is simply looking for the point that's a high, sorry, the point that's a low, so they can buy, or they're looking for the point that's a high so they can sell. That is the basic concept of trading, to understand the point that's a low so you can buy, and understand the point that's a high so that you can sell. This is the most simplest form or concept of trading. And now, depending on the kind of person that you are, what might be my low might be your high. What might be my high might be your low, because there are different types of traders in the market, and we are going to look at those type of traders in the market. Right? Now, this is like the beginner's course of trading. I'm trying to make you understand this thing in the beginner's concept as a complete total beginner. Let's look at the type of traders in the market. Whenever you come to the market or whenever you open the charts, there are three major group of people in the market, right? There are three major types of traders in the market. The first one is simply refers to as scalpers. Second one is simply the what? Day traders. And the third one is simply the what? The swing traders. Now, remember I said to you that depending on the kind of person you are, that what might be my high might be your low, and what might be my low might be your high. So different persons or different type of traders have different concepts to understanding the point that is a low and the point that is a high. That's why we have the invention of ICT, SMC, BTBT, all those things, LBS, BBL, all of those things are simply what different persons from this category use to understand the point that is a high and the point that is a low, so that they can buy or so that they can sell. Now look at the first person here, simply a scalper. A scalper is simply a person or someone who takes advantage of short time movement immediately in the market. That means this person is simply in and out of the market within a short period of time. A scalper. Now, a day trader is simply a person who opens the market, come in the morning and look for an entry opportunity, identify that opportunity, and then execute a trade. Now, he doesn't care what happens until the day closes. Then you can know if you had a loss or if you had a profit. That simply refers to as a day trader. And for the swing traders, it's simply a person or someone who simply buy from one swing, say from one swing to the next swing. That means you're swinging a trade from one swing to the next swing. That you're not going to exit until price take out a particular what swing. That is referred as a swing trader. Remember, different persons have the point of high and the point of low for them. For instance, what might be a high for a swing trader might be a low for a day trader, and might be a lower low for another trader. Different persons use different concepts to understand the point that is a low, that is a high, and most importantly, trying to obey the concept of trading, which is identifying a point of buy and a point of sell. Right? Good. Now, let's look at the section in trading. That as a trader, there are simply various kind of sections in trading that you want to trade. For instance, a scalper might choose to say, I'm going to only trade on the New York section. I'm only going to choose London section. Different persons have different sections that they like to trade. And there are basically about three major types of section in the market. That means we have three types of section in the forex markets. The first one is simply refers to as the Asian section. We have the London section, and we have the New York section. Now, these three types of section is simply moving in cycle. That because we have three types of section, it's moving in a cycle, and I'm going to make you understand the cycle of which these sections are moving in. Now, the first one here, which simply refers to as the Asian section, is simply referred to as the Tokyo and the Sydney. Right? That inside this Asian section we have two types, the Tokyo and the Sydney section. That once price opens, it opens with the Eastern section. The Tokyo opens and then give birth to what? The Sydney section. The Sydney opens and give birth to what? London section. Right? And London give birth to what? New York. and the cycle continue. It's moving in cycle. That's why the price is always open 24 hours. Right? Now, this sections has a particular currency pair that it favors. That means if this is open, it has a specific currency pair that it favors. For example, if this one is open, it favors any pair that has AUD, JPY, and NZD. Right? That's anytime you see that this pair is open, it favors any pair that is attached, any pair that has AUD, JPY, NZD. That means these pairs or any currency pair paired to these particular three pairs tend to move fast or volatile in the market. That means it favors what this particular pair. Now, when it comes to the London section, it has a pair that it favors. Very good English. London section also has a pair that it favors. That this particular section favors both the GBP pairs, GBP, CHF, and the Euro pairs. These are referred to as European sections, and it favors any pair that is paired with GBP, CHF, and Euro. These pairs are simply going to be volatile during the what London section. Now we'll have the New York section, which is referred to as the USD. Now this section favors any pair that is paired with USD. That means if you have a pair that is paired with USD, it tends to be very volatile or move fast during the New York session. And it is best to either trade any of these pairs that you want to trade. But between these three sections, these two are the most popular. Are you following? These two are the most popular because when this is open, these two are closed. And when these two are open, it becomes more volatile. More people are coming into the market, and because more people are coming into the market, it becomes very volatile, and price tend to move very well in these two sections. Are you following? Let me know if you are following in the comment section. Now, for you to be able to understand or use all of these things I've explained earlier on, you simply need to understand how to analyze the market, right? Being able to analyze markets is the major thing that will give you an edge for you to understand the point to buy and the point to sell from and be able to make money, right? Analysis. Now, there are two major kinds of analysis in markets. We have the fundamental analysis and we have technical analysis. These are the two major kind of analysis in the market, and I'm not going to go into fully to show you how to analyze the market, because remember I said to you that for you to know the point you're going to buy from or sell from, you simply need to either use any of those things I've explained before. I talked about ICT, BBL, SMC, LBS, supply and resistance, supply and demand. That is what I'm going to use technically to understand the point that is a low for you and the point that is a high for you. And in my next video, I'm going to use or show you the system that I use to analyze markets, and probably you could learn from it. But let me give you a brief summary to what fundamental analysis is. Fundamental analysis is simply the use of economic data to understand where price is going to go to. Right? That means you are simply using what's happening around that country's economy to determine how strong the currency is going to be or how weak the currency is going to be. So the whole point is this: that fundamental analysis is simply the use of economic activities, political activities going on in a particular country to decide how weak or how strong their currency is. That is referred to as fundamental analysis. Whereas technical analysis is simply the use of previous price data to understand where price is likely going to go to. Now these two work hand in hand. What this means is that one cannot do without the other, and the other cannot do without one. Like I said, I'm going to show you how I do my own in my next video. So just subscribe, like, and share this video. Now the last part, or the last point, remember I said I'm going to use 7 points, and this is the sixth one. Now the last point, which is simply psychology. Just spelling psychology. Right? Now this is the most difficult part because it tells you how you're going to react to or respond to a particular trade. It has to do with your emotions that will enable you make a good decision or a bad decision. And like an army, you have to go through a training that will enable you to be able to understand how to overcome the psychology behind trading. And it requires proper training and proper mentorship for you to be able to overcome this, right? And that is why most times it's advised that you go for mentorship for you to be able to undergo the training that enables you to overcome the particular phase, because it's very difficult. That'll be all for this video. I'll see you in my next video where I'll explain how I use my analysis or how I use my strategy to understand the point that I'll buy from and the point that I'll sell from. I'll see you in the next one. Peace.